In the United States, billionaires often pay lower effective tax rates than nurses, teachers, and truck drivers. This isn't a glitch in the system, it's the system working exactly as designed. The ultra-rich have mastered legal strategies that allow them to avoid paying their fair share, all while watching their wealth grow exponentially. They don't rely on salaries. They don't need to cash out. Instead, they leverage complex tax codes, borrow against their wealth, and use charitable loopholes that sound generous but are often self-serving. Foundations, trusts, offshore entities, and asset-backed loans. These are not loopholes most people even know exist, yet they're completely legal and used at the highest levels. Meanwhile, working-class Americans face audits over small deductions, while billionaires pay armies of accountants to ensure they don't pay more than they legally have to, which, in many cases, is close to nothing. This isn't just a story about taxes. It's about power, policy, and the growing gap between those who play by the rules and those who write them. In this video, we're pulling back the curtain on how America's richest avoid taxes without breaking a single law. You won't see this on cable news, but it affects every single taxpayer. One of the most powerful and legal strategies billionaires use to avoid income taxes is deceptively simple: buy, borrow, die. It's not a tax dodge hidden in offshore accounts. It's baked right into the US tax code. Wealthy individuals don't accumulate their fortunes through traditional paychecks. Instead, they buy appreciating assets, stocks, real estate, art, or shares in private companies. These assets grow in value over time, but crucially, those unrealized gains aren't taxed. For example, Jeff Bezos can own tens of billions in Amazon stock. As long as he doesn't sell, he pays zero capital gains tax, no matter how much that stock increases in value. According to ProPublica and Equitable Growth, this asset-focused wealth model allows billionaires to build immense fortunes without generating taxable income. Need cash? No problem. Instead of selling stock and triggering taxes, the ultra-wealthy borrow against their holdings. Let's say someone owns $100 million in stocks. They can go to a bank and use those stocks as collateral to take out a loan with incredibly low interest rates. Because they're considered low risk, the assets themselves back the loan. Since loans aren't considered income, they're not taxable. It's perfectly legal and massively advantageous. This borrowed money can be used for anything: buying property, funding luxury lifestyles, even investing in new ventures. Meanwhile, interest paid on these loans can often be written off. The DC Fiscal Policy Institute highlights that this borrowing mechanism creates an income stream for the wealthy that's effectively tax-free. Eventually, everyone dies, but here's where the real magic happens. When a billionaire passes away, their heirs inherit the assets, not at the original purchase price, but at their current market value. This is called a step-up in basis. If a stock was bought for $1 million and is worth $10 million at the time of death, the capital gain of $9 million is wiped clean. No one pays tax on it. That $10 million becomes the new baseline. This step-up rule means the wealth can be passed down again and again without ever being taxed. Business Insider and Wikipedia have both broken down how this mechanism allows dynastic wealth to grow untaxed across generations. The entire strategy, from acquisition to inheritance, is entirely legal. It's been used for decades by America's wealthiest families. According to The New Yorker, it's one of the reasons the richest Americans can live off billions without ever touching their taxable income. To be clear, this isn't tax evasion. It's tax avoidance. Fully legal, fully compliant, and massively effective. While average Americans are taxed on every paycheck, the ultra-rich can go years, even lifetimes, without paying federal income taxes in proportion to their wealth. This trifecta, buy, borrow, die, doesn't just preserve wealth. It builds dynasties, protected by laws that most people don't even know exist. And unless those laws change, the game will stay rigged for generations to come. Beyond simply buying assets and borrowing against them, America's wealthiest employ a toolkit of sophisticated financial structures designed to shield their fortunes from taxes. These tools may seem complex, but they're entirely legal, and they allow the ultra-rich to avoid paying taxes while preserving and expanding their wealth. 3 of the most common strategies: dynasty trusts, charitable foundations, and paper losses. One of the most powerful tools used by billionaires is the dynasty trust. This structure allows wealth to be passed down through generations without triggering estate taxes. Typically, when someone dies and passes on their wealth to heirs, the estate is taxed, a process known as the estate tax. However, dynasty trusts bypass this tax entirely. By placing wealth into a dynasty trust, billionaires can ensure that their descendants will receive this wealth without paying estate taxes for multiple generations. The wealth remains in the trust, continuing to grow while the tax burden is minimized. As long as the trust exists, the taxman is kept at bay. This is how families like the Waltons, the heirs to Walmart, and the Kochs, Koch Industries, maintain massive fortunes. According to The New Yorker, these trusts can last for hundreds of years, creating effectively untouchable family wealth. The ability to shield wealth from taxation for generations creates a divide between the ultra-wealthy and average Americans who pay taxes on any inheritance they receive. Critics argue that these dynasty trusts perpetuate wealth inequality by allowing the ultra-wealthy to build and transfer wealth across generations without paying their fair share of taxes. Another commonly used tool is charitable foundations. While these foundations are ostensibly set up to benefit charitable causes, they can also serve as a tax avoidance mechanism for the wealthy. Here's how it works. When billionaires donate large sums to their own charitable foundations, they receive a tax deduction for the donation. This helps reduce their taxable income and, therefore, their overall tax liability. However, the control doesn't end there. These wealthy individuals still have significant influence over how the foundation's funds are spent. In many cases, they or their family members sit on the board of directors and determine the foundation's priorities. As a result, much of the money doesn't actually go to external charities but instead circulates within the family's sphere of influence, funding causes that benefit their interests. This creates a situation where the tax benefits are enjoyed by the billionaire, while the donations are often used to bolster their own family's influence or wealth. ProPublica reports that wealthy families such as the Gates and the Kochs use foundations not just for philanthropy but also for preserving wealth. These foundations offer the dual benefit of allowing billionaires to make tax-deductible contributions while retaining control over the funds. In some cases, foundations are used to fund lobbying efforts that align with the billionaire's interests, making them more of a tool for influence than charitable giving. The third strategy billionaires use is paper losses. This technique involves using investments in certain ventures to generate losses on paper, which can then offset other taxable income. For example, an investor might purchase a sports team or a large piece of real estate and report a loss based on depreciation or other accounting practices, even if the underlying asset has appreciated in value. These paper losses don't reflect actual financial setbacks but are used as a tool to reduce taxes. If someone loses money on paper, they can use that loss to offset gains made in other investments, thereby reducing their taxable income. ProPublica points out that real estate investments, in particular, are a common vehicle for creating these artificial losses. Many billionaires are known to leverage massive property portfolios, taking advantage of depreciation rules that allow them to deduct the cost of their properties over time, even though the properties may be increasing in value. While this tactic is widely used, it highlights the discrepancy in how different types of income are treated under the U.S. tax code. For ordinary people, wages are taxed as income, but for billionaires, it's not the same. By using paper losses to offset taxable income, the ultra-rich can significantly reduce their tax burden while growing their wealth. These tools, dynasty trusts, charitable foundations, and paper losses, are all part of a system that allows the wealthiest Americans to shield their fortunes from taxation. While legal, these strategies raise serious questions about the fairness of a tax system that seems built to benefit the ultra-wealthy at the expense of the broader population. As the gap between the rich and everyone else continues to widen, these practices stand as a stark reminder of the rules that govern the game, and the ways in which the rules can be bent to favor those at the top. tax avoidance doesn't stop at national borders. For the ultra-wealthy and major corporations, the world is a financial chessboard, and offshore tax havens are among their most powerful pieces. While average citizens file taxes every year under strict scrutiny, billionaires and multinational firms use an international network of shell companies, secret jurisdictions, and accounting tricks to move their wealth out of reach. Jurisdictions like the Cayman Islands, Bermuda, the British Virgin Islands, and Luxembourg have turned tax avoidance into a business model. These places offer two critical services: extremely low or even zero corporate tax rates, and near total financial secrecy. According to Wikipedia and the Tax Justice Network, these havens attract trillions of dollars in wealth. It's not just yachts and private accounts. Entire corporate structures are routed through these jurisdictions to take advantage of loopholes. The secrecy laws protect the identities of true owners, meaning even investigators can struggle to trace where the money comes from or who benefits. This isn't just theory. In 2021, the Pandora Papers exposed how hundreds of world leaders, CEOs, celebrities, and billionaires used offshore havens to shelter wealth. These are not rogue actors. They're household names operating within a system built to favor them. Another layer of protection comes from shell companies. These are legal entities with no employees, no offices, and no actual business operations. Just a name, a mailbox, and often millions or even billions in assets. Why do they matter? Because they can be used to obscure the true ownership of wealth. A billionaire might own dozens of shell companies spread across multiple countries, each controlling assets or routing income. The result is a web of ownership so complex, it's nearly impossible to unravel without deep forensic investigation. These shell companies aren't illegal by themselves, but their structure allows for shadowy movements of wealth that frustrate regulators. Criminals use them to launder money, but billionaires use them to lower their tax bills and avoid scrutiny, all without breaking the law. A 2023 DC Fiscal Policy Institute report noted that while shell companies are sometimes associated with corruption or crime, they're equally a staple of elite financial planning. The very structure of modern capitalism encourages opacity when it benefits those at the top. For multinational corporations, there's an additional layer: profit shifting. A US-based company might sell a product in France, but report the profit in Ireland, where the tax rate is far lower. Or even in a country where the tax rate is zero. This accounting tactic is completely legal and widely used. Take Apple, for example. Before a crackdown in 2017, Apple shifted enormous amounts of revenue to Ireland to avoid higher US tax rates. Other companies like Amazon, Google, and Facebook have all been scrutinized for similar behavior. According to The Atlantic and Equitable Growth, U.S. corporations are estimated to hold over $1 trillion in offshore profits to avoid U.S. taxation. This isn't just an issue for America. Developing nations lose over $200 billion annually due to corporate profit shifting, according to the International Monetary Fund, IMF. That's money that could fund schools, hospitals, infrastructure, but instead, it sits untouched in offshore vaults. The global consequences are staggering. When the richest people and largest companies avoid taxes, governments are forced to make tough choices, either raise taxes on middle and lower-income citizens, cut spending on public services, or increase debt. Public schools go underfunded, roads fall into disrepair, and healthcare systems struggle, all while billionaires legally stash money in countries most Americans couldn't point to on a map. The Tax Justice Network estimates that over $500 billion in tax revenue is lost globally every year to these offshore schemes. This is not about breaking the law, it's about exploiting the gaps between laws. And as long as those gaps remain, the richest will always find ways to shift their money beyond the reach of taxation. Offshore havens offer more than financial privacy, they offer power, permanence, and insulation from the responsibilities that come with vast wealth. The game isn't rigged, it's just globally optimized for those who know how to play it. The Internal Revenue Service is supposed to be the watchdog of the tax system. But when it comes to the ultra-wealthy, that watchdog has been effectively muzzled. While billionaires build complex financial empires and maneuver through global tax loopholes, The IRS is stuck trying to keep up with outdated tools, shrinking staff, and limited resources. According to the International Consortium of Investigative Journalists, ICIJ, over the last decade, the number of IRS employees assigned to auditing high-income individuals has plummeted by over 40%. Budget cuts and political pushback have severely weakened the agency's enforcement capabilities. In 2012, the IRS audited more than 1 in 10 millionaires. By 2022, that number had fallen to fewer than 3 in 100. The result? While working-class Americans are more likely to get flagged for small mistakes or missing paperwork, billionaires with sprawling portfolios go largely unchecked. Part of the problem lies in the sheer complexity of the ultra-rich's financial structures. These aren't basic W-2 forms and tax returns. Billionaires employ teams of lawyers, accountants, and wealth managers who specialize in creating legal mazes that obscure income, defer liabilities, and shift assets offshore. Some structures take months to build, and would take years for the IRS to unwind. Even if the agency flags something suspicious, it can be nearly impossible to prove wrongdoing when every move is shielded by legal technicalities and layers of professional defense. And it's not just the complexity, it's the political firepower behind these strategies. Over the past few decades, lobbying efforts funded by wealthy individuals and corporations have reshaped the tax code itself. Provisions and loopholes have been carved into the law on purpose. These aren't oversights. They're the result of deliberate influence campaigns on Capitol Hill. The DC Fiscal Policy Institute and ProPublica have reported how tax laws are often written with input from industry lobbyists and high-net-worth individuals. This means that even when the IRS wants to act, it's often bound by laws that have been rigged in favor of those it's supposed to police. The result is an enforcement gap that favors the wealthy. Billionaires can spend millions to avoid taxes and still come out ahead. Meanwhile, the IRS, underfunded and overburdened, struggles to hold them accountable. In 2023, Congress approved additional funding for the IRS aimed at increasing enforcement on high earners. But the backlash was swift. Politicians warned of IRS overreach and pushed to scale back the funding. Many of these same lawmakers receive campaign contributions from the very individuals and corporations benefiting from weak tax enforcement. This isn't just a policy issue. It's a power imbalance. One side has armies of advisors, global assets, and political influence. The other is an agency with limited tools, battling to ensure that everyone pays their fair share. Until that imbalance shifts, the richest Americans will continue to operate in a parallel financial universe, one where taxes are optional, consequences are rare, and the rules can always be rewritten. Every strategy we've explored, from trusts and foundations to offshore accounts and profit shifting, is completely legal. But legality doesn't equal fairness. These loopholes don't just preserve billionaire fortunes, they redistribute the tax burden downward, forcing everyday Americans to carry the weight of a system designed to favor the few. When billionaires avoid taxes, public services suffer. Schools lose funding. Roads go unrepaired. Healthcare systems strain. The consequences are real, and they're paid for by those who can least afford it. This isn't just a tax story, it's a story about power, priorities, and the future of economic justice. If this video gave you a new perspective, hit that subscribe button and turn on notifications so you don't miss what's coming next. Comment below, should the tax code be rewritten? And share this video if you believe more people need to understand how the ultra-rich stay ultra-rich.